The Japanese yen was once known as a symbol of economic resilience. It has weathered through various global economic crises, from the Asian financial crisis of 1997 to the global financial crisis of 2008, consistently serving as a safe haven currency. However, in recent years, this stability has eroded, and the yen has been on a steady decline, reaching levels not seen since the early 1990s. Here's a graph of the Japanese yen compared to the United States dollar. Since the start of the 21st century, the yen has shown strong strength against the dollar. It was trading around 100 to 130 yen to a dollar, but eventually showed strong resilience during the global financial crisis. As the graph depicts, the yen was even once valued at around 79 yen to a dollar. This was because of the global financial instability that led investors to seek safe haven assets, including the Japanese yen, which was considered a stable store of value. During the 2008 crisis, central banks around the world, particularly the US Federal Reserve, slashed interest rates to stimulate their economies. Japan's existing low interest rates and the relative stability of its economy made the yen an attractive option, pushing its value up against the US dollar. Throughout the next 10 years, and even during the COVID-19 pandemic, the Japanese yen had performed relatively well and was stable throughout the pandemic. But if we enter the years after the COVID-19 pandemic, we see this. The yen had dramatically declined in value, reaching its lowest point in decades. This has led investors, analysts, and economists alike to scrutinize the underlying causes and speculate about the future of the Japanese currency. Many factors have contributed to the yen's recent decline, creating a complex picture influenced by both domestic policies and global economic trends. So, why? Why did the Japanese yen slide in value? Wasn't it a global safe haven that won against the COVID-19 pandemic and the global financial recession? Well, to understand that, we must first talk about an important actor that plays a massive role in the yen's fate: the Bank of Japan, BOJ. The BOJ has been implementing what is called monetary policy. Monetary policy refers to the actions taken by a country's central bank to manage the economy by controlling the money supply and interest rates. These actions influence borrowing, spending, and overall economic activity. The BOJ has kept interest rates very low for a long time. And when we say long, we mean a very long time. Here's a chart of Japan's interest rates, and it clearly shows just how low it is. Even if we compare it to major economies like the United States, you see a huge divergence between the two countries. The reason why the BOJ did this was because they wanted to encourage borrowing and spending to boost economic growth and prevent deflation, a situation where prices keep falling, which can hurt the economy. By making loans cheaper, the BOJ hopes people and businesses will spend more, stimulating the economy. In contrast, however, the US Federal Reserve has been raising interest rates to combat high inflation when prices rise too quickly. Higher interest rates make borrowing more expensive, which can slow down spending and help control inflation. As a result, investments in the US become more attractive because they offer better returns. This difference in policies creates a gap between Japanese and US interest rates. Investors prefer to put their money where they can get higher returns, so they move funds from Japan to the US. To invest in the US, they sell yen and buy dollars, increasing the supply of yen in the market and reducing its value. This process leads to the yen weakening against the dollar. The low interest rates in Japan also encourage a practice known as carry trades. Investors borrow money in yen at low costs and invest it in countries with higher interest rates to earn a profit from the difference. This activity increases the selling of yen, further contributing to its depreciation. To top off the interest rates, there are big problems with Japan's economy itself. One big problem is their reliance on energy imports. Here's a graph of Japan's imports by category. The largest one of all is mineral fuels, oils, and distillation products. Being reliant on imports isn't really bad, but the reason why it's bad for Japan is because the country has maintained a trade surplus, exporting more than it imports. However, in recent years, this surplus has diminished due to factors such as increased energy imports and a decline in global demand for Japanese goods. Here's data showing the balance of trade in Japan. For the past year, from September of 2023 to September of 2024, Japan has only recorded 4 months out of 12 in trade surplus, and the months where it recorded surpluses were minimal compared to the deficit. If we extend this data and look at the 3-year time frame, the story even paints a darker picture. Month after month, Japan has been recording deficit after deficit. Why is this the case? Well, as we just mentioned, it is both because of the weak demand for Japanese goods and the continuous imports of Japan. But it's not just that. The weak yen also impacts Japan's trade. If the Japanese yen depreciates in value, it makes imports more expensive. That's because imported goods, like energy and raw materials, become pricier in terms of yen, as Japan needs to spend more of its own currency to acquire the same amount of foreign goods. Now, what's very interesting about this is that the BOJ has actually increased the interest rate. It increased from a negative of 0.1% to 0.25%. But even though they did this, many investors are skeptical about any more continuous increase. They believe that the BOJ will not make any major moves to actually push interest rates high. Why? Well, one big problem that is seen in Japan is its debt. Yes, many know that Japan is the world's largest holder of debt. As of 2022, Japan's gross public debt as a percentage of its GDP is a massive 261%. No other country in the world right now has a debt that's as big as this. Just take a look at the United States. Many are calling out the government to fix their debt problem. Yet it's actually nowhere near Japan's size of debt as a percentage of its GDP. But then, what's the connection between a country's debt and its interest rates? Well, if the BOJ increases interest rates, then it could have potential negative consequences for the country's debt situation. Higher interest rates mean that the government will have to pay more in interest on its debt. With Japan's debt to GDP ratio being so high, even a slight increase in interest rates could lead to a huge rise in debt servicing costs. This would strain the government's budget, potentially leading to cuts in public spending, higher taxes, or even concerns about Japan's long-term financial stability. This is a major reason why the BOJ is cautious about raising rates aggressively. Now, there are other ways for the BOJ to intervene in stabilizing the yen. It's called currency intervention, and it happens when a country's monetary authorities actively buying or selling their own currency in the foreign exchange market to influence its value. In Japan, the Ministry of Finance, MOF, decides when to intervene, and the BOJ executes these interventions on behalf of the MOF. The primary goal is to prevent rapid and disorderly movements in the yen's value, which can disrupt economic, planning, and trade. Recently, they have done this. The MOF conducted a record single-day yen buying intervention on April 29th of 2024, selling 5.92 trillion yen, $40.83 billion, to counter the yen's fall to a 34-year low against the dollar. An additional 3.87 trillion yen was spent on May 1st, totaling 9.79 trillion yen in interventions during this period. There were also suspected interventions that occurred as the yen approached a 38-year low, with authorities potentially spending another 5.53 trillion yen to support the currency. Unfortunately, while interventions can provide temporary relief, their long-term effectiveness is debated. Factors such as global economic conditions, interest rate differentials, and market perceptions play significant roles in determining a currency's value. For instance, despite substantial interventions in April and May 2024, the yen continued to weaken, reaching a 38-year low in July 2024. Now, the most important piece of this story is understanding the impact on Japan's economy. What is the impact on Japan and its people? Is it bad or good? Well, for one, a weaker yen makes Japanese products more affordable for foreign buyers. This price advantage can boost sales for Japanese companies that sell goods overseas, such as car manufacturers and electronics firms. For instance, when the yen's value drops, a car priced at 2 million yen becomes cheaper in dollar terms, making it more attractive to international customers. But as we just mentioned, a weak yen raises the cost of imported goods. Another major problem is that when these imported goods become more expensive, it contributes to inflation, meaning the general price level of goods and services rises. While moderate inflation can be a sign of a healthy economy, rapid price increases can erode purchasing power, making it harder for people to afford necessities. A good part of this, however, is that a weak yen makes Japan a more attractive destination for tourists, as their foreign currency can buy more in Japan. This can lead to a boost in the tourism industry, benefiting hotels, restaurants, and retailers. There are a lot of good or bad things about having a weak yen, but for now, you at least understand why the Japanese yen is so weak. But anyway, do let us know what you think. Thanks for watching.